Okay, so we use the Bollinger Band model, and particularly we decide to concentrate on the weekly time frame and weekly chart. You might want to ask me, why did I decide to go for weekly chart and not the monthly time frame, the daily time frame? Now, a lower time frame has a lot of noise in it. So, but a weekly time frame filters out the noise. That's benefit one. You have the opportunity to see the trend as it is over a considerable period of time. The second advantage is that it gives you spend less time watching the market. You don't want to be day trading. You don't want to be looking at every reaction in the market. You want to see the reaction over a week and see what should I be doing next. Because you're following the trend and your trade can last for weeks, months, as long as your strategy says you are still in the market. The other advantage of it is that with a weekly time frame, apart from spending less time, apart from filtering the noise, it's a longer duration, is a trend following in a way. You want to see a trend and you want to trade the trend in a way over a long time. And these are part of those tools. You trade less, because the more you trade, the more likely you will lose. You will make errors in your investment decision, and you begin to make so many trade entries, which could result to distorting your objectivity about the market. But when you trade less, you're like, okay, I just want to pick one or two stocks based on what my strategy tells me. If I don't see it, then I don't trade it. I don't try to force the market to give me a setup. It is what the setup has done on the weekly time frame. I don't go down below just because I want to be buying. So you take few positions, and the fewer positions you take, the more likely you would make profitable trade. The fewer position you trade with your model, the more likely you win most trades. So that's an advantage of using the weekly time frame. We were practical, basically, and we talked about some things about these time frames, which the Bollinger Band that we worked on. I hope you can remember.
Yeah.
Now, we said we want to identify the trend. Now, we want to trade when it is correcting, when there is a correction. What I mean is this. I'll explain that. Two, we want to let the volume, we want to make sure that price, we want to identify the trend using the MEs, using the moving average, using the EME, EMEs, 200 and 100. You get that one? Two, we want to look out for price correction. The third one is we want price to be at the lower Bollinger Band. I hope you get that.
Yes.
Then there's now what they call conviction. Now, the point of conviction is that we want to see the three align: BB, EMA, lower Bollinger Band. The three align. Then additional conviction is we want to see patterns. like the W shape, pin bar, or an hammer. Then further conviction is when you have volume. Now, I'll be able to get this one. So let me now start explaining this one by one so that you have an idea. You have a graph, which I know you do, but you need to. Okay, so when we say the most important thing is we want to ensure that price is trading above the moving average. Now, at that point, we see that the price is in an uptrend. Are you with me, sir?
Yes, I'm with you.
Now, we say that when price is trading above the moving average, price is trading above the moving average, we say it is an uptrend. That's the first element. It's trading above the moving average. It's in an uptrend. That's one thing we want to first of all confirm. The next thing is that, okay, let me draw it in this way. We want to say the price is trading up 0.1. We want to now come down to 0.2 when there's a correction. So we say 0.1 is this and 0.2 is this. But what makes us know that this is 0.1 is when price is trading above the moving average. Now, 0.2 is what we are looking for. We know that it's an uptrend, but there's a correction. So we have identified the trend by saying price is trading above the moving average, like what we have here now. So we are looking for our 0.2, and this 0.2 is when price has corrected. There's a correction. And this correction is at the point where it's either it touches, the most important thing is the Bollinger Band. It touches the Bollinger Band, the lower Bollinger Band. Now, that Bollinger Band must be contrasting. It must not be expanding. You remember that condition?
Yes.
Now, when it gets there, we have established a correction, we have established there's a trend. So we now want to have a conviction that our entry, this signal is better, is when there's a confluence or around these three. When price has come to touch the moving average, at this point too, at this point, the moving average is serving as support and resistance. Remember, we treated the concept of support and resistance in our intermediate class.
Yeah.
Moving average now serving as support. Plus, there is a Bollinger Band at that point too. That is, moving average touches the lower Bollinger Band. Plus, there's a pattern. Whether pin bar is like an hammer. It's another name for hammer. We treated these two. I remember we did that. So
yeah, we
like
did.
an hammer. Then further conviction is that this is where we want to now optimize is the more. Is when we have what we call W shape. Let me take time to explain the concept of W shape to you, so that you have an understanding of W shape and volume. We treated volume too, but W shape and volume. Now, when we say W shape, look at what W shape is. You see the market is up, up, up. Look at this. I hope you are seeing my diagram here, sir.
Yes, I'm seeing it.
Very good. When you have this and you see this, then when price goes down, goes up, come back to around this support, then this is more like a W shape, and you see it go up, then it's like W shape. It start going up. Let's say this side has not formed, but it started pointing up. Then you see a W shape is forming. Now, when it now breaks, it's a confirmed W shape. So, but at this point is a point where you look at. Now, you also look at this. You see something like this. It didn't touch this lower. I hope you didn't see. It has an higher low. It's a W shape.
Yeah.
Now, when you now see this one, it's not a W shape. So you don't take this signal as important. You still take this as good and this as what? Good. I hope you get that.
Yeah, I get it.
Good. So let's try to implement everything we've looked at now. It's practical. So now let's look at one of our case study last week, which was Zenith. I hope you remember.
Yeah.
So what happened to Zenith now? The Zenith has been trading above the EMA 200 and EMA 100 at the weekly time frame. It has corrected. It's trading above it. It started trading above it around October 2020, went up and corrected back to test the moving average at the confluence of Bollinger Band. Am I right?
Yeah.
Good. Now, do we have a W shape? That's the question we need to ask ourselves.
No.
No. So not really a good signal for us. But you can trade it, but it doesn't have a good signal. So you leave this one, you go to another one. Before I now explain how to not determine your stop, let's look at guaranteed trust plan. Do we have the signal come on it? Now it's in between the 100 and 200, so that's another point. Now, you may also take consideration of it when it's in between. When price is in between EMA 200 and 100, you can still take it as relatively important because it's more cheaper. What you want to do, the idea is you want to buy at a discount. If you see that, you can still decide to say, I want to take the trade. Now, this is it's not even, let's say starting a W shape. What do I mean by that? We had this, and we had this. You starting to just on our trend. Now, remember our volume analysis, which is the last part of conviction. We have an higher volume.
Yeah.
When we had a bullish run. So in actual fact, let's look at the system again. Up, down, then the new signal that you want to follow is here. Price is at both the moving average and the lower Bollinger Band. Formed series of patterns, especially in this point. There's volume conviction to say there's a new buy. So I can still take the signal.
Well, that volume there is not as high as the volume immediately to the left.
You look at it relative to the immediate past volume. This volume to this volume. So the idea here is this: there's a directional conviction, which means that there's increasing market participation. This week's volume is higher than the previous week's volume.
Okay.
So it means that there is a conviction, there is higher increasing market participation. That is the meaning of that volume. So when you see the volume increase beyond that, there's increased market participation, in what direction? Is a green. It is that the bullish side in the direction of the bulls. If it has been a red volume and we had a bull candle like that, then it is an inverse relationship.
Okay.
Let's look at another signal, then we look at one more thing. Let's look at, I usually use this strategy mostly for the banks. It works well for banking sectors a lot.
Okay.
Asset doesn't fit into it. It's expanding, it's about expanding downward. Let's look at another one. Fidelity now is finding it's trading above the EMAs, but did not touch the EMA. Rather, it touches the lower Bollinger Band. How do you see that? But there's something important here. That's why I have to look at it as very important, which will be part of those things we may probably be looking at for next week for allocation of our funds. Is that now there is conviction, higher increasing market conviction in it. There's volume to back it up. There's a pattern on the lower Bollinger Band, though did not touch the moving average, but it's trading above the moving average. So it almost touches the moving average, but there's more like a W pattern in a way. This is a low, this is a low. So this is like the same, around the same low. That's what I mean. Did you get what I mean now? Hello?
Yeah.
Sorry, tripped off internet. Okay, I hope you can see my screen.
Yes, I'm seeing the screen, but the W pattern is not clear in this case.
Yes, the W pattern is not clear. It's not clear, but the most important thing here, let me show you what I looked at so that you have, is that there's support here that it slightly breached, but it eventually is back up around it and formed like a spinning bottom.
Okay.
So it's, you now see there's a full W when it starts going up. So this is stock we are looking at. And there's a conviction here. This is stock we are looking at. Let's look at another one. Let's look at now we are, remember this strategy. Now we are dealing with the entry. We are going to be dealing with the exit too shortly. Let's look at UCAP. This one does not, it has already gone past the entry. It has already gone past the entry. Let's look at, we can trade this. Let's look at, okay. Let's look at UBA. Interesting. Yeah, this is interesting. Now you will notice something that is very interesting here. There's a cluster of patterns around the 200 EMAs. Are you with me, sir?
Yes.
Good.
I see it.
But my only issue is that there's an expanding Bollinger Band. So the interesting part is I want to look at what it's going to do. If the Bollinger Band contrasts in the coming week, so we may give it a consideration. So, like I said, I only trade few stocks in a year in the Nigerian stock market using this strategy. Few stocks in a year using this strategy. Let's look at some. Let's look at some. Because, but those stocks gives higher gains. It can give, by the time the entry comes in, we can have like 40 to 50% ROI by the time you are exiting. So it makes it easier. You don't bother yourself with the various noise. Nigerian market is characterized with a lot of manipulation. So let me say noise, a lot of manipulation. Now, when you manipulate, there are a lot of manipulation around it. Let me show you one of the Dangote is the number one stock used for manipulation. Now you hear the market is
Okay.
rising. You need to filter out the naysayers, the outliners. And the outliners are the Dangote, the MTN. They are all outliners. You have to be careful about them. You have to take them out to filter it before you know whether truly the market is going up or not. The likes of Dangote, MTN, Nestle, Seplat, all of these stocks, you have to just remove them from the whole index and now say, is the market truly appreciating or the market is truly depreciating? But I'll give you one simple formula for trading Nigerian market. You don't need to stress yourself.
Okay.
The simple formula is very simple. By October and November, by late October, start buying banking stocks, start buying Dangote, some few stocks that are in the top high cap stock, blue chip. Don't go for the penny stocks, just go for the blue chip by October. And I guarantee you, by the time you are exiting by January, you will make nothing less than 30%.
Okay.
You could have asked me why. I was expecting you to ask me why. It's a simple thing, manipulation. Most pension funds and the likes, they want to close their book by December, which is the financial year. And their investment in all of these stocks adds to their assets. Part of the figures they will declare. So they will definitely want to push the price up, so that by the time they finish preparing their financial year end, there will be an increase in the value of their asset and portfolio.
Okay.
So most times, after using this Bollinger Band model to trade one or two stocks, the next thing is this: I'm off the market. I wait till October, November, then do my trades if I want to do that in the Nigerian stock market. So that's a simple formula, and I can guarantee you for the past, let's look at it, whether I'm right or wrong, for the past 5 years, it has always been like that. Let's look at the monthly time frame. Let me put NSE All Share Index. Okay, good.
So what time frame is this one?
This is a monthly time frame, though. Monthly time frame. So you will notice that all this appreciation you are seeing are not on the other stocks, are just on the major Dangote and the lights.
Okay.
So, but by the time we get to October, which is this, we start seeing a strong appreciation. Now let's find another October. This is another October, December. This is okay. November, December, January. Look at it. This. Let me bring it down. This is one. This is when you now see another big one. This is the one for last year. Let's find another one. This is another October, November, December, January. So this one extended till February. Let's find another one. Obviously, this one's
So
another one.
this one now, you said by October.
By October, exit January.
So, but this one now, from what you just said now, it's like in January, the price of the stocks are pretty, of the index is low.
Yeah, by the time you get to January, February, the price start coming down. Now, what it means is that by that time, they'll be selling off their portfolios. The late comers will be coming in. So they just set it off. They finish their financial year-end reporting or preparation of their financial year-end report books, and that's so. You just don't show yourself, pick those stocks, 2, 3, 4 stocks, make some 20, 30% gain. You are good. That's a strategy around that one.
So if the price is trading low at that January, that means you want to be out before the January now.
Yes, by the time you're getting to end of January, you should be out of all your portfolio. Because I guarantee you by February, you're going to see a decline.
Okay.
So you have seen this happen currently for the past 5 years. So the trend will always continue to repeat itself. And this will continue to happen. So back to our system. Now we have optimized it using the W shape. Now the question is, the system should be able to tell you when to enter and when to exit. Now, when we've tried to identify when to enter. Let's try to identify when to exit. When we are talking about exit, there are 2 types of exit that are important. Note it. The first exit is when you are wrong. Remember, we are not God now. Not all system will work all the time, but there's a higher probability that it will work. But when we are wrong, can the system point to us that we are wrong? Simple. The simplest way you can know that is this, without stressing yourself, is when price now goes below the 200 EMA. The moment price goes below the EMA 200, you are wrong. And most importantly, below an historical support. We know that we are wrong. At that point, the Bollinger Band would have been expanding. Then we are wrong. So you just exit your position. Let's look at this simple example so that you have an understanding of it. Now look at this name. This one is the 200 EMA. The yellow one is the 100 EMA. Now the moment price has gone below the 200 EMA, it tells us that we are wrong.
Okay.
So there's no need for you to even deal with that again. So if you are in a position and notice that price goes below the 200 EMA, let's go back to our zenith. Now, where do I put my stop? Where do I think of putting my stop? My stop should be below the 200 EMA. And importantly, you must find an historical resistance that is, or historical support. So this should probably be your point of exit, about 18 Naira 20 kobo. The moment price goes down below the EMA 200 and 18 naira 20 kobo, there's no need for you to deal with there's no need for you to be in this particular stock again. Look for something else. So no need for you to hold it so that there won't be further depiction in the value of your stock. So when we are thinking of exit, that is one. And that is simple, a simple way to handle it. Simplicity is key. You don't need to stress yourself with so many complex things. The moment price goes down below this EMA, then at that point you are wrong. The trend has changed. Remember, what the moving average does is it helps you to know when the trend has changed, and you're trading the trend. So you are wrong. You just need to be off the market or close the stock, take your loss. We don't win all the time. It's part of the game. But you want to win most of the time. And you want to make good trades. Now, that's for exits. Simple way to use your exits. Now let's look at for that on our stop loss level. When in our take profit level, profit taking zone, there's a strategy I usually use. There are two strategies I use for profit taking. Now, number one is I calculate in terms of using, say when I do 50%, that is when in terms of numbers, so when it moves from a particular level to a particular level, and I calculate, for instance, now let me give you what I mean. Like when I do 50%. Now, what I mean is this: if my stop loss, if the point for my entry, let's take this for example, 22 naira 33 kobo is a point of entry, hypothetically, minus 18 naira 20 kobo is a point of exit. I hope you get that. 20 that minus 18 naira 30 kobo, so 20 kobo. I'm talking about 4 naira 10 kobo. Isn't it? Now, if price should add, if there's an addition of 4 naira 10 kobo, from my point of entry, which means that 4 naira 10 kobo plus 22 naira 30 kobo, that is, it gets to 26 naira 40 kobo. I'm taking off 50% of the trade. I'm exiting 50% of my trade. That is, at that point, it gets to 26 naira 40 kobo. Then I exit 50% of my position. So the remaining 50% now, I wait for it to touch the low upper Bollinger Band. Did you get this to approach?
So this is for exit.
Now, in terms of take profit, why exit in terms of stop loss is when it goes below the moving average, 200, and to below the historical support. Now, for entry in terms of take profit is when there's a rally. Assuming we take this Zenith Bank trade, and I've said that my exit point in terms of stop loss is 18 naira 20 kobo, and I take this stock at 22 naira 30 kobo, I subtract it, which means that I'm risking 4 naira 10 kobo, isn't it?
Yeah.
Now, if I'm risking 4 naira, I'm ready to lose 4 naira 10 kobo. Now, but if it continues to trade in that direction after I've entered, and it gets to 26 naira 40 kobo, which is this point. This is about this point. And a rally to this point, hope you get, you see, now I rally to this point. What I'll do at this point is that I'll exit 50% of my position.
Okay.
I will now leave the rest for price to touch the upper Bollinger Band. Here is our stop loss. Here is our take profit 1. And the next upper Bollinger Band is our take profit 2.
Okay.
How do you get that, sir?
Yes.
So it's a simple way of determining your stop loss and your take profit. So you don't need to stress yourself. You will have done your calculation on an Excel sheet or any sheet paper. Okay, I've entered at price X. I'm exiting my stop loss. If I am wrong, is at price X minus X, which is Y. Now that Y, which is what I'm ready to lose. But if price rally in my favor by that same number of Y, I add it to my X, it gives me XY. I exit 50% of it. Then I let the 50% keep on running till it gets to the upper Bollinger Band. Just simple as that. I love simplicity though, so. Any questions, sir? Hello? 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 Hello?
Yeah. Like
Okay.
the network went off.
Okay,
I
so
hear you now.
okay, good. So I hope you can still see my screen.
Hello. Yes, I can see your screen.
Did you get the calculation? Did you get the calculation?
Hello?
I'm with you, sir. I'm with you.
Okay.
How do you get the approach now, the calculation approach for exit?
Yes, I get it.
That's a simple way to any question. What question do you have around that? So you have used this one to determine our stop loss, and you have used this one to determine our profit taking zone. Any question? I hope you get it. You understand it.
The profit taking point.
Mm.
So It's like I didn't really get that one very well.
Okay, let's go by it again. Let's take this example. This is Zenith Bank, and the current price is 22 naira 30 kobo.
Okay.
That's the price. That's our entry price, for instance. And we have identified our stop loss that below the movie EMA 200 and historical level, which is at this point,
Yeah.
and it's at 18 naira 20 kobo. 18 naira 20 kobo. So what we did was 22 naira 30 kobo minus 18 naira 20 kobo, which means that we are risking 4 naira 10 kobo.
Okay.
So if the stock depreciates by 4 naira 10 kobo, you'll be out of the market.
Yeah.
Good. Now we now said this 4 naira 10 kobo, add it to this 22 naira 30 kobo, which means that when you make 4 naira 10 kobo, for instance, now in the profit level, that is price start going in your favor, and there's 4 naira, and it gets to 26 naira 40 kobo. That is 4 naira 10 kobo plus 22 naira 30 kobo is 26 naira 40 kobo. Exit half of your position.
Okay.
So when you exit half of your position, you still have 50% left, half left.
Yeah.
So you want to see when price touches the upper Bollinger Band. Remember, we've been dealing with the lower Bollinger Band for our entry. Then the upper Bollinger Band will be now for the remaining exits.
So once price touches the upper Bollinger Band, we take out the remaining 50%.
Take out the remaining 50%. Why? Because most of the time, it finds resistance, dynamic resistance at that point. Though it could expand, but most of the time it finds dynamic resistance at that point. So take out the remaining 50%. You may decide to say, okay, I want to take out 25%, I'll take out 50% of that 50%, leave the remaining 50% till anyhow. But for me, I take it out outrightly.
Okay.
So when we are working on the profit taking, we are looking at what we are risking. We want to make what we are risking that is, if we are risking 410 kobo, X amount, we want to see whether we can make that same X amount, because that's our objective. But we won't take out 50% of it and let the remaining start running. Because remember, we are trend following. So until there's a change in trend, so we want to follow the trend.
Okay.
So what you would do is this, what you do for me. So your assignment now will now be double.
Okay.
Now you would, apart from using this signal to determine stocks that you want to buy, you want to now calculate your stop loss, calculate your take profits.
So that is using the Bollinger Band strategy.
Yes, definitely. In optimizing it, apart from choosing your stock where you now enter using those Bollinger Band, moving average, and pattern, you want to now further optimize by using W shape, the pin bar, and volume. Then you now determine, okay, I'm buying at this price. This is where my stop loss will be, and this is where my first take profit zone will be, and this is where my second take profit zone should be. It's a bit of a work. Like somebody, like my mentor will always say, we are not collecting certificate, we are using it to make money.
Yeah.
I hope you get that. Huh?
No. Yes, I do.
Good. Good. Spend it. Okay. So I think we could stop with this down. So the next week, what I will finalize with you is I'll just put you through for Fibonacci.
Okay.
That will work with our daily time frame for that. So if you want to, like, I want to have so many positions. I don't want to be taking 5 positions in a year or 4 positions in a year. I still want to be taking relatively higher positions. We can go to Fibonacci on that. So far, any question?
Okay. Well, let me just review first.
Okay, good.
Because